Hello, and welcome to another Block Chat. Today we'll be discussing a subject we've discussed before partly, yet we'll deep dive in it. We'll discuss why should people tokenize property. Obviously, while discussing that, we will discuss why should people buy tokenized property, what tokenized property should you buy and what shouldn't you. Not that we're telling you to or not, we're just trying to help you with your research. So take us as a small session within your research to decide if tokenized property is for you, to decide if tokenizing your property is right for you. Today, on another block chat with Denis Petrovcic and Makram Hani. Dennis, how are you?
Good, good. Doing well. Yourself? Hasn't been a bit of time and since we
Yeah,
had a blog chat together, right?
we've done solos and with other individuals, members of the team, but we haven't done a block chat since some time. And
Exactly.
guys, we miss it, yeah. So we every time we skip a few weeks without doing block chats, we miss how we do it. But maybe it's good, yeah. We unlearn and we relearn how and what and why. That's good. Dennis,
Exactly.
why should anyone tokenize their property?
Why shouldn't they? That's I'm biased. I'm biased, of course. I've been looking
Sorry,
at
guys,
tokenizing.
we exactly the answer came. That's the perfect answer. Thank you for being with us on.
Exactly. No, but honestly, if we conceptually look from, we're always looking at from today, or whenever we ask the question to ourselves, why should somebody tokenize real estate? We look at it from the current situation around us, the current environment. If we look at it from a future environment, and we imagine certain technological advancements happening, um, you see that inevitably real estate is going to be tokenized because today, we're talking about AI a lot, for instance, and agentic AI. And currently, agentic AI is there with a human in the loop or guided by a human. And a lot of tasks are still overseen by a human. But in the end, its actions are pretty much digital. And if you look in 5 years' time down the road, who's going to be buying and selling real estate for us? It's going to be agentic AI. Now, those transactions are going to happen digitally for sure because it's going to be easier. It's going to be easier to manage this kind of portfolios in a way that is more instant. But obviously, there's a lot of things that need to happen. And if you go back to today, whenever there's somebody who wants to tokenize real estate, and let's say it's a property owner that knows their business, they have great assets, they have great opportunities, and they want to share those opportunities with other investors around. Just like they share things on Instagram and TikTok and want to have followers. People in real estate want to have followers who want to invest with them. And I think that's the main reason why you want to tokenize or why you need to look at tokenization today to have people follow your investments in real estate. And that's the perfect way of doing it. That's my take, right? And a lot of times people in real estate, they're introverts. They're not extroverts. And there's not many times people in real estate that they're out there, sharing things, except maybe real estate agents. But those the real investors are keeping it for themselves. So there's a mix of type of investors right now. Some are more extrovert, and those maybe see tokenization as the path forward. Those who are more introverted, obviously they're carefully evaluating the space. But that's my take. So
While
back
you
to
were
you.
saying
My the same question goes to you.
on the
Why would somebody tokenize real estate today?
while you were saying, agentic agents, AI agents would be buying our real estate in the future. I imagined a slogan that says similar to you've been buying real estate physically, and now it's time to give your AI agent the opportunity to invest himself. So, so something like that. Look, I would separate it into several categories. One, why would real estate tokenization be used on an institutional level? Why would real estate tokenization be used on an individual investor's level? And here, there's obviously multiple reasons for each. I will start with the institutional, and then we roll to the individual. On an institutional level, tokenization allows you extended efficiency, among other things. As you see today, most of the financial institutions globally are running to tokenize real estate. I believe, and correct me if I'm wrong, I just said Goldman Sachs. Is it Goldman Sachs?
I think so, yeah.
Tokenized a new real estate fund. It's one of the big guys. Sorry if it's the wrong name, guys. It's one of the institutions of the world, the financial institutions that we all look up to and say they are the golden standard, have just gone ahead and tokenized a real estate fund. Now, why would they do that? There's multiple reasons. As I said, one of them is the transparency. Second is the easier governance. Third is the easier liquidity, access to liquidity. The fourth is the increased accessibility. Fifth is efficiency, reduced cost. Remember, in funds, a big part of the game, other than AUM, is compliance, cost of administering the fund, operating it, cost of business developing, and there's multiple. It's a whole machine that's running. Whenever you're able to tokenize that and move most of it on chain, obviously the elements, the conventional elements will stay there. Tokenization is not a magic word that fixes all. It fixes multiple of those elements. It facilitates them in an easier way. It makes real estate more accessible, real estate fund more accessible, 24/7, and higher efficiency allows higher profits, because obviously if you charge the same fees and it costs you less to do it, then you pay less eventually. So in other words, you make more profits. On an institutional level, there's multiple reasons why. Now, that is tokenizing funds, but similarly, real estate asset managers, real estate developers may choose to tokenize projects, because how tokenization can reform the capital stack is second to none. And without using much of technical jargon here, the ability of a real estate developer to raise different types of money is essential. Ability of an asset manager to raise different types of money. And for those who are listening who are not part of that environment, usually a developer would raise mezz funding. Probably sometimes they use construction funding. They have some senior debt. They have some junior debt. They have multiple types of secure and non-secure instruments that they use within their capital stack to make it as efficient as possible, and to make it as possible to create the revenues and the IRRs that they target. Now, this is allowed within tokenization at a different level, the level of efficiency, the ability to work around with the different forms of debt that you raise or equity that you raise is available in tokenization. And we will talk about it in a second now when we reach the retail, the individual, you and me, and how would we tokenize things on an individual level, and why would we tokenize things. We will also talk about why would people buy tokenized real estate, and why would they not as well? What real estate that's tokenized that they shouldn't? So when it goes to retail, an individual may want to not sell their asset, may want to raise a bit of money for either a business, or partially they're going into retirement, they would require some liquidity. And by the way, we're talking about those are cases that we're currently discussing and talking to. Those are individuals that we're currently talking to. So it's someone who does have the property, likes the property's returns, does have a certain level of liquidity needs, but does not want to sell the whole property, does not need to sell the whole property. That individual can tokenize 10, 20, 30% of the property, can raise liquidity. It may be better for him cash flow wise than the bank. You tell me borrowing, and that's a specific case we were talking about. they have a great loan on the property. And when we were discussing tokenization, I said to Dennis, why would anyone? Because although we're infrastructure providers, yeah, we're here to help people, facilitate to people and help people do what they want to do. We're not here to neither investment advisors nor to advise people for or otherwise. But we discuss it, and we're human beings who discuss with others our opinions. And I was saying, why would anyone uh, remove um this loan and replace it with uh, this form of liquidity creation? They have a loan, they're raising liquidity. And Dennis said they, yes, will have a higher cost probably because they will be paying the whole return to the individual who will be buying the tokens, while they only had, what was it, 3% as a cost of loan
Yeah.
currently. However, their cash flow will improve. And when I looked at it, it does make much sense. If I'm 70 years old, I obviously want to leave something for my kids, but I want to also be able from my real estate to earn the most possible today as free cash flow, not as cash flow, as free cash flow. And that's one of the reasons people can tokenize. Now, we'll discuss more on that, and we'll discuss many of the other reasons, and we'll discuss why would people buy that real estate or not. Dennis, when I was talking, I saw you pondering about probably the ideas that people would or wouldn't buy tokenized real estate. Why would they buy tokenized real estate, and what tokenized real estate should they not buy? Before that, what are the reasons people should not tokenize for? Reasons that people believe are possible within tokenization, but we should tell them if that's your target, do not approach tokenization.
Um, yeah, there's probably just as many reasons why not as they are for tokenization. And we see them coming to us all the time. And a lot of times people want to use tokenization to raise money to acquire an asset. I think that crowdfunding part is very tough, especially if you don't have a track record. I mean, if you're a real estate developer and you have tens of millions of deals in the past, at least, that you've done in a specific market, then yes, you can do it because people know you in that market, and you can go and raise from investors within that market plus a bit of international investors. That's perfectly fine. But a lot of times we get somebody or a company that comes to us and well, we want to do this developer thing because we have this opportunity with this plot. We just need to buy the plot and then build something in Nicaragua. And nothing opposing to Nicaragua. It's a great, interesting market
Far
and
away.
country.
You're mentioning a
But
country
but
that's
I
far
am
away.
but I'm just mentioning something that's far away from me, and they expect people within, I don't know, from Europe to invest there. Yes, maybe that's something, but most probably this is going to need to be investors who you will offer them, I don't know, individual units that they can maybe buy into and use. I know a lot of developers in Thailand have done it the same way, and been successful. And even in those cases, the developments stall because of lack of building materials, labor, expertise, etc. And so, in a project that used should be 1 year, it then turns out to be 3 years, and so forth. So there's delays, and obviously, when you make an investment, time is of the essence, right? And I think when people then apply tokenization to something like this, and it's a first-time project for them, it's I doubt they will be successful because tokenizing, it means then publicly exposing yourself and saying, hey, we're doing this, we're raising money. However, if you have already made the investment yourself and you're now brought the investment to a stage that is, pretty much okay, and there's, everything is set in there, and you can maybe monetize earlier on the value add that you've done, that's perfectly fine because you have an asset you can use to collateralize the tokenization with. So I think that's an okay case then. Um, I would say as well, a no-go would be um, a a property that is, by all means, it's not worth what they say they are. So a lot of times we have somebody who owns a property. They're saying it's worth, I don't know, 1 million, but when you do a quick due diligence process, you see that properties of the same type in the same region are selling for, I don't know, 350 or 400K. Why they want to tokenize it at the 1 million valuation is because of the aspiration of the cash flow that it could produce, which is great, but you still have a couple of steps to do and prove that there's a market for it. And so until you have tenant contracts, that's not the valuation, because it's just, a hearsay. This property is going to make 150 net per year. It's not. Or maybe it is, but prove it first. And a lot of times they're blocked because they need the financing to get there. But they have maybe the ownership of this type of property. And so I think their tokenization can happen only at a discount, because there's a risk that needs to be taken by any investors who enters. And offering tokens at a valuation without any discount at that moment, I think that's not feasible, and people should not do it. And as well, investors should not enter into those kind of deals, in my view, that don't discount for the risk that they're taking. There might be
Dennis
other
is trying
cases
to
as
say,
well,
in a
but
polite way, is garbage in, garbage out. What is garbage in the conventional world is garbage if tokenized.
well, I'm saying that it doesn't mean that a real estate asset is not a good investment. It's just the price point might make it a bad one, you know? Because a lot of times real estate is might be just fine, if but the price needs to be good as well. Then you can do something with it, right? And then it turns into a good investment. Yeah.
Yeah, it's a brilliant asset. It doesn't mean it's a brilliant investment. And here, look, when you magnify with tokenization the benefits, you do magnify the hiccups, you do magnify the handicap. If tokenization is a method for you to uh, put add fuel on the fire in a positive way, it's also a method to add fuel on the fire in a negative way. But more so, something that's very important here, you should tokenize what would sell. There is something that's said every day out there. There is no liquidity on chain for tokenized assets. How many times have you heard it, Dennis?
Many times.
Every week,
Many
10 times.
times.
There's no
Yes.
liquidity on chain for tokenized assets. Guys, there's no liquidity anywhere for rubbish assets. Yeah.
Mhm.
What you need to consider is the following. If you have a property in neighborhood and your neighbor may be interested to buy it, because they want to live in, because they like it, because they have memories with the tree that's beside it, because their brother lives on the other corner. Those are reasons for someone in your neighborhood to buy the asset, sometimes pay a premium for it. When you go on chain, yes, you have maybe the liquidity premium here that's created with time. And yes, there's methods for you to extract the most value out of that. But people on chain are not less sophisticated, are as much or more sophisticated, while the reasons why they buy it is the interest in it from an investment point of view. It's not the interest in it from an end user point of view. It's a brilliant property, it's a legacy destination. Not really. It's a property that makes sense numbers wise. Risk appetite suits that property. People would look at it and say, okay, those numbers tick the boxes. Now, when you have tokenized it and you have extracted the liquidity for multiple reasons, maybe you're extracting the liquidity to upgrade that property and achieve a higher revenue. Maybe you're extracting that liquidity for a different project you have. There is multiple reasons why would you go for tokenization. None of them is to be able to get introduced or target less sophisticated, non-knowledgeable buyers who would just pay anything for your
Look,
property.
let's run an example that's not in the retail space, but it's more on the institutional side. So one of the trends that has been happening as of late in institutional asset management, at least in Europe, but I think it's kind of worldwide, um, it's these institutional asset managers have managed billions or are managing billions of assets that are owned by pension funds. Like, let's just simplify it. Pension funds have a specific internal rate of return target with real estate, and it's fairly low, right? But they need consistency and longevity of investments, right? And they need to be present with assets in markets with high liquidity. So, that means the top 60 cities in the world are the target. Obviously, other investors are all present there in those markets, and then they transact between each other based on liquidity requirements of the investors. And this liquidity is, or transactional activity is decreasing year over year now, but targets need to be met. Now, where do these investors divest into? If other funds are not buying from them, is it going to be private equity funds? Maybe, but that was already a trend that ran through. Is it going to be REITs? Maybe that was as well a trend that went through. And the trend right now is activating wealth management arms that cater to another type of investors, which for them is retail, which is high net worth individuals and family offices. Now, a family office or a high net worth individual, will they ever invest? And they're sophisticated investors. It's not going down to, they might be even tougher to talk to because they have their own personal goals, right? And they're more personally attached to the investment than any pension fund because that's managed by a committee, investment committee that says, yeah, sure, the numbers make sense, let's do it. You know, um, and here they expect to find liquidity with this set of players and what introduce them to 100 million property in Munich and say, hey, we are opening up a ticket of 30 million to invest in this property. Will they sell it to a family office? I don't think so. Because it's a big ticket, and it's not the size of it that is the problem, but it's the liquidity of it. Because then as soon as you enter into this investment, you're basically um, your exit is planned whenever the institution will exit, and so you're locked into that investment. So that's a position you might not want to take as a private investor. And for instance, here tokenization is one of the rare answers that make sense on that level. And I'm saying here that the investors that are coming into through tokenization don't necessarily need to be the full retail that you and I think of right now. It's the person down the street. It can solve problems also on higher levels, and the sophistication. If it's smaller tickets, the concerns can be higher, and it's the same thing when you apply it to this retail level. When you have a property that is, I don't know, a 5 million property, and you are trying to get people to invest through the purchase of tokens with tickets of 5 to 10K or 1K. Their concerns are much higher than the concerns maybe of an investor that would come in with 3 million into that same deal. So I'm saying that tokenization just creates additional issues or additional responsibilities, let's call them, towards investors, because the investors that you are inviting in are smaller investors than the ones you were talking to before. And the relationship is obviously different. And I'm not saying,
But Dennis here
yeah,
is if we categorize that and we dismantle it, um, in a conventional world today, if a fund owns a category B, grade B commercial asset in Milan and would like to get investment in through private equity, through different set of asset managers, there is a process that involves parties who are high cost, methods that are high cost, pretty sophisticated to extract that liquidity and get it in. That liquidity cannot go out also except in a certain way through certain methods and channels. So it can go through a private asset manager, and then that private asset manager creates an instrument, and that instrument is sold to certain type of investors, usually accredited investors. So here you have two things. One is accessibility, as an individual, maybe non-professional investor or non-accredited investor in many markets, you will not be able to have access to that. Second, your entry point, you may not want to put 2 or 3 or 4 million into one investment. Now, when the owner tokenizes, it gives him the ability to access a market that today they can't access. It gives him the ability to serve a market that today he can't serve, but it also gives the investor the ability to enter and exit in a different way. Now, usually, a less liquid investment requires higher return because with less liquidity comes higher risk and comes many other elements attached to it. If you make it much more liquid, it's less return is okay. In other words, it's more profitable for everyone while it's generating the same level of return. If you go, I am actually looking today at a fund. In our group, we have an investment entity, and we're looking at a fund, and we were looking to do some deployment of cash, and we found a fund that's perfect. It ticks every box we need. The only caveat is it's so non-liquid. The entry is, if you enter today, you need to consider that it's 10 years. You need to forget about this funds or access to it or access to funding related to it. In other words, that cash is not to be touched in 10 years. And that doesn't suit us. Everything else ticks all the boxes. So now we're going for an investment that returns much less, that is liquid on a monthly level with T plus 2. So at any moment of time, within 48 hours, 72 hours, we're able to access a portion or a full of our money. And that makes more sense. Imagine that it's tokenized, thus it's liquid as the markets are. And the benefits that come to that for the tokenizing party, and for the individual who's buying this token. Now, that doesn't mean every property is right to be tokenized, and that doesn't mean every situation is right to be tokenized. Sometimes accessing tokenization for some properties, some setups, some assets require higher cost of compliance to make sure it's compliance, and the token that will come out on the other side will not be the right token for investors in the market. In other words, as we say, you can sell anything, but every sale comes at a cost. The better the quality of the product is, the lower the cost is. The worse the quality of the product is, the higher the cost is. So it may not be feasible to tokenize and sell certain assets, but the right asset, and it should be the right asset, tokenized, creates a better investment for both parties, the tokenizing party and the party buying that token. Now, Dennis, to make it easier for those who are watching today and say it's right for them to come create their own platform and tokenize. And we may probably be having someone who's sitting currently in Nicaragua, currently in India, currently in Dubai. Forget about Dubai for now on a tokenization level, because Dubai Land Department have done something probably ahead of any other market globally today. Yet there is very clear guidelines now on what, how, and why to do things. But in any market, somebody sitting, living there today who wants to tokenize a certain asset, why and what makes his intent logical and feasible, and why and what makes his intent non-logical and non-feasible? So who should contact us after that to access
Yeah.
tokenizing their assets, and who shouldn't?
Look, from our point of view, it comes down to the legal framework and the output through that legal framework. So we're really well equipped to tokenize real estate assets within Europe under MiCA regulation. That's something that we have a clear framework on how to achieve. When it comes to properties outside of this jurisdiction, a lot of times there's quite some back and forth of what can be done and cannot be done. And a lot of times we would hesitate from tokenizing and listing on Ocean Point. And therefore, the preference there is that you run your own marketplace, where you obviously need to establish the marketplace yourself and to take on certain risks that come from offering a certain type of investment on the market. The reason for it is that with the tokenization framework we have within Europe, we can really put a charge on the title of the property and collateralize the tokens. While in other jurisdictions, that's that's not necessarily something that we can achieve as of now, or that we can achieve but might not have the overview of how safe that is as a position for token holders. So when it comes to what type of real estate assets, I think it's really agnostic, and there's no real differentiation between, residential, office, industrial, hotels, student housing, whatever. So I think with development projects, the interesting part is that there's a clear exit. So the secondary market liquidity is not necessarily something that's required. So it eliminates one element, I would say, from the equation, especially when you market it to potential investors. But it brings additional risks. So, and if you're not able to subsidize those risks with the discounted valuation or with a fair pricing on the token, and returns in development projects, I think they should be in the 20-25% for um, across, maybe not per annum, obviously, but across the investment, that should be at least the target, somewhere in those figures. And if you're able to present that to investors, then you will most certainly, I think, attract a specific amount of online crowd that would, enter that type of investment. But the horizon needs to be clear, and you need to have a track record. Whether, prior to you tokenizing an asset, you should have pulled off a couple of development projects. Like, for instance, the partner that uses Flipstone from Portugal. They have done, I think, something like 16 or 18 million worth of deals so far in the market where they're present. So they know their market, they know their methodology, and they're adding tokenization into their stack as a layer of the future, I would say, and as well to ease the entry level for smaller tickets. I think right now, I think they have like 150K ticket per investor minimum, but with tokenization, they am I back?
Yeah,
Um,
we lost you for a second.
yeah, I
Um,
see. And it's switching the screens constantly.
that's AI, guys.
Um,
It's not us.
it's not us. But I think, one of the things we need to as well discuss today is, why projects that go with tokenization, why do they fail to scale? I
So
think
let's
that's
summarize, Dennis.
that's
Let's summarize before we go into that. Why tokenize
okay.
real estate today? Raise capital, unlock
Yeah,
liquidity,
yeah,
finance growth, reduce bank reliance, and build investor communities.
yeah.
Simple reasons, yeah. Which assets tokenize? Any asset works with tokenization. Yet there are obviously certain assets that should be tokenized in a certain way, not another. But you can tokenize any asset that exists logically, and it does make sense. Obviously, student housing is a better class asset that is easier to tokenize and create returns on an individual asset level than maybe industrial. Yeah, because the ability of an individual to understand the asset and what does it entail is much easier, but obviously with more risk. In other words, less knowledge. Risk is generally attached to the ability to know about something, and your capacity to know about something. Then comes a higher return. Development projects obviously come at a higher cost generally. Yeah, so that's something that you need to look at because it's a slightly higher risk element.
But
What are the things that can go wrong?
for the
Yeah, sorry.
developer, just before we go into the things, because it relates to the things that go wrong. When you tokenize real estate, a development project, a lot of times the comparison that developers who come to us, they come with a comparison. They say, well, um, bank financing is low cost for us. It's pretty good, but right now the costs are, they have increased. Um, and then they come with, the comparison with mezzanine financing and, uh, and that part. With tokenization, if it's done in the way we do it, you can de-risk your position as a developer because your development horizon might stretch, but that doesn't default you. It doesn't push you into a default position if you don't deliver on time. Yes, it increases your cost, but it doesn't push you over the edge, right? And
And Dennis, how you create your token, the format of your token, can make your token sit as any of the capital stack elements you mentioned. It can sit like senior debt, it can sit like mezz debt, it can sit like equity, each at a
yeah,
cost, but it can sit as any of those. It wouldn't be sitting, you can't format a token like mezz debt and price it as senior debt. You cannot. There's no takers. Yes, there's no takers. Why? Because people out there do understand the difference between one another. The more you complicate it, the higher harder it is for them to understand. In other words, the more narrow your circle of interest is, isn't it?
exactly. And it's like I said, you can't compare, bananas and oranges. It's a different thing. It's still fruit, yes, but it's a different type of fruit, and some people like one over the other. And here it's the same thing. And when you're tokenizing an asset, you can't just say, well, then it's much better for us to go for senior debt. Yes, senior debt is one route of financing a development project, but it has its own specific metrics and parameters and confinements. And if it works for you, then yes, go to a bank, take a loan, build the project. Why are you even talking about tokenization then? You can't come and think of mezzanine financing at the cost of senior debt. You can't go for equity partners and compare it to senior debt. Nobody does that. So why would you compare tokenization with senior debt? You don't. It's a different beast. It's a different thing, and
Unless you
it
unless you
obviously
frame, unless you position tokenization, unless you frame it, unless you draft
it,
it as senior debt, unless you do
it
that, it's not senior debt.
exactly. Exactly. If you draft it as a senior debt, then obviously you can lower the expectations of returns. But if it's more like equity, then obviously it takes, it mimics the risks of equity in a way. Then obviously those are the returns that will be expected. And the way we modeled it is that it never really matches just the risks of taking an equity position. They're lower, they're subordinated to any other debt tranches, but they're um, prior to, above equity. And so, in a way, you are de-risking the token holder, which means you can expect, and give a lower return than for the equity holder. But at the same time, it needs to be obviously generous enough to attract an investor into the deal.
It's
Yeah,
flexible enough for you to create the format you want, as long as it makes sense and logical. If you want buy it, don't try to sell it. Yeah.
exactly.
What if things go wrong, Dennis? What if there is a vacancy? What if there is a falling values? What if there is a bankruptcy situation? What if there is a, fraud situation?
Well, when it comes to tokenization,
How to
I
protect
think,
from that first? What should you look for as a buyer of a token?
well, you should look, in the contractual agreements that are in place that are tying the token to the asset, right? How is that part composed? And it depends obviously on the tokenization model. Um, when a lot of times when the economic benefits are being tokenized, like in our case, there's a lot of times no protection at all. There's just a a contractual agreement between the offerer of the tokens and the token buyers, and that's it. And there's a written
There's legal
obligation.
protection. There's no blocking, you mean, but there's legal protection at the end of the day.
There,
They
of course, yeah. And when you're buying a property in Nicaragua, and then you're basically being protected by the Nicaraguan legal system. So you need to trust that system, and that's, I think, the part that a lot of people don't understand. So, for instance, I would go and buy into tokenized real estate in jurisdictions that I trust, the legal system, and I
and that
think
you
that's
understand, because trust comes from
exactly.
also understanding. Maybe somebody who's Nicaraguan definitely understands their system much more than they
Of
understand
course.
the German system, and thus can invest in their jurisdiction in a much better way. Yeah.
Exactly. It's like Slovenia is a great market, but there's a lot of investors who would not enter into this market because of not, language barriers or not understanding the legal system or not knowing, people here. So when there's no protections, the legal system matters. However, when you have protections in place backing the token, like in the case of our tokenization framework, where a charge can be put on the title during the issuance process, um, then obviously these risks are much lower and go more towards that senior debt, protected, let's say, type of investment, which give you as a token holders protections if things go wrong, right? But a lot of times things go wrong, and it doesn't mean a default, and it doesn't mean anything else, but just things go wrong. And they go wrong in real estate. For instance,
A vacancy.
co-
Vacancy takes place. How do you deal with
COVID,
that?
for instance, COVID came, and now all of a sudden the office market is not booming anymore. It's actually declining, and there's less and less requirements for office space. That's something that's happening. And then to add on top of it, now you have this AI boom that additionally creates more or less requirement for office space. So, but more requirement for data centers on the other end, and for electrical infrastructure. So there's shifts in the market that happen, and they're outside factors, right? And all of that impacts the bottom line of a real estate investment. When you invest through tokens into a real estate asset, those things matter and they happen, and there's no protection against them. Just like there's no protection against these factors when you invest directly into real estate as a direct investment. If you would buy into an office space in Dubai, and then or in London or whatever, and then all of this happens, obviously there's a decrease of potential tenants who would lease the space from you. Now, what do you do when those situations happen? I don't know, Makram. Maybe you're the real estate guy here, but you most probably know best what happens. And it doesn't have anything to do with tokenization, just like it doesn't have anything to do with the equity partners in that deal. If there's multiples, right? There's a decision to be made, and there's an action to be taken. And if you have a senior debt tranche on that property, you are in very shallow waters, and it might be very risky if you don't move and do something about it, because obviously you have a recurring obligation towards your financier, and the financier, the bank, doesn't care that the market happened, and in the end you're going to default. With tokenization, that risk is a bit shared, because a lot of times the agreements that happen are protecting the asset owner against this kind of situations. So it is a de-risking mechanism that can, if implemented at the proper time, help out a property owner fight and navigate those situations.
Always remember, if it's tokenized, still there is an underlying asset. All of those issues are an issue in an underlying asset. It can go vacant, it can go less demanded, prices can drop, um, God forbid, a fire can happen. And each of those have mitigation elements that you need to take. If you own this property outright, you own it with three friends, you own it with two companies, you own it through a token holds a set of rights. As we said, a token can act as equity if this is how it's formatted. A token can act as mezz debt, senior debt, junior debt, fully collateralized, over collateralized, or none. And any of those do have sets of responsibilities, rights for all parties involved in the transaction. If you are tokenizing, you need to decide which one suits you, which one works for you. And part of which one works for you is to avoid the failure points usually. No demand. Yeah, no demand because it's either not priced right from a revenue perspective, or it's not the product that's right for the market, or it's so complicated for the market that you're trying to target. Yeah. If you're trying to target retail investors, they don't want over complex stuff. They don't want legal jargon, 400-page document. They want something that's very simple, very direct to the point, and very clear. And that's a reason why you should do it in a way, not in another way. Weak distribution. Choose the right distribution. In other words, that depends on your product. What's the right distribution for that product? Poor quality of an asset. Format your asset in the right way. Putting a price at above what the asset can demand, can claim, is a wrong approach. You started with a failure point. You didn't end with a failure point. You didn't get to a failure point, and you should expect to fail at that level. Lack of trust. You have an asset, you have a plan. You didn't buy the land yet. You have a great presentation that can be generated over an LLM in few minutes, hours, I don't know, and you have very little track record of meaning, and then you're trying to raise money. It's all points of failure that you've collected and put on in one tokenization project. Um, you have regulatory hurdles because you haven't looked at those yet. You have limited liquidity, and generally it starts with bad product, bad distribution. That's how you create bad liquidity. So if you're a token creator, if you're a tokenizing party, if you're a party who owns real estate today, regardless of the category of real estate, think about tokenizing it the right way. Yes, you can get the tech from someone like Blocksquare. Actually, you do get the tech from Blocksquare. But Blocksquare does not solve the whole elements for you, including elements in the underlying. The underlying is an asset that needs to be looked at as what it is. If you're a token buyer, you need to do the same. You need to look at the underlying and say, I'm buying into that property. You're not buying crypto here. You're buying a property. And how you're claiming your ownership of a property, it's through a token. That token can be 700 years ago, a paper, a note stamped by the mayor. And today, it can be on chain, a token with a smart contract attached to it, stamped by, in an immutable way, by a system. And that's the same, but it's the property that you're buying into. It's not the token itself. And even if the framework is a senior debt over collateralized structure, because still there should be someone in the back of that that would present himself when there is a default. Otherwise, if you don't have an underlying and you have that, know that party, a default, regardless of how secure on paper it is, has holds no security. Yeah, those are things that you need to look at if you're either on either side of the spectrum. Dennis, I believe we've covered most of what we should have covered here. We actually jumped way beyond the regular 30 minutes we said, but I believe we've given sufficient reference and knowledge to parties who may be looking at that. What else would you like to shed light on?
No, I think we've covered quite a lot of things in the block chat. I think we should be talking more about the reasons why people should tokenize real estate, because I think it's something inevitable. Right now, we're talking about liquidity. Is there liquidity for your product? What kind of product do you need to have to find investors? And all of that part. But in the end, it's tokenization is a product that allows you to find liquidity online, like, just to simplify it. And there's no other product on the market that's built for real estate that can help you achieve the same. There's nothing else like it. And so if you believe you could attract the attention of 1,000 investors or 5,000 investors or 100 investors um, into your deal, whatever that deal is, then tokenization is for you. If you don't think you can achieve that, if you would like to have a magic, or not a magic, but a single point of capital access, then you have private investor markets in your region. You can go to an investor, knock on their door, make a deal that suits you and suits them, and find financing that way much easier than with tokenization. And
If you're coming
I
to
think
us
that's
for
it.
magic liquidity, you have the liquidity, you have the product. We give you the tech. We don't give you the magic liquidity. Liquidity is available out there. There's abundance of money, guys. There's $8 trillion set today to be sitting on the side, looking for places to be deployed in. $8 trillion. You can pick up few millions from that. I believe if you have the right product, the right tech, we can present you with that. That's something we can provide you with. But the right product is something that you need to come up with, you need to create. And the market is out there. You just need to target it right. And if Goldman Sachs, pardon me, Goldman Sachs, if it's wrong, is targeting that out there now with a fund of few hundreds of millions, I believe it's right for you, for your coming project or your current project, isn't it? Anything else, Dennis, you would like to share with our community?
No, I think we've covered the topic of today's block chat. For our community who watches us every other week now, it hasn't been every other week, but we've slowed it down just a bit. Maybe it's every 3 weeks now. There's lots of things that we're working on and we're delivering, and there's news coming as always. And even through this kind of bear market, we are pushing forward and doing our jobs and delivering code, and working on real estate tokenization from different angles, solving problems that will one day make real estate tokenization the golden standard for real estate. So I think that we have next week we have some interesting AMAs coming in on Twitter. I think organized, some of them organized by our marketing team, and some by others. But yeah.
I want you to do something now when you finish this blog chat. Go on and write down on a piece of paper 10 projects that you've been following since 2018, since you started following us or looking at us, and track the history of to date. in tech, in blockchain. Yeah, I'm not talking about hospitals that you've been following. Go on, write them down. If you reach number 10, give us a comment, say that, please. And hopefully, we'll see you in the coming 20 years. Thank you so much for being part of our energy and being part of our history. Until next time, ciao, ciao.
Ciao.